Corporate earnings and basic supply and demand used to dictate asset prices. Today, those metrics take a back seat. Algorithms and highly coordinated trading syndicates are intercepting the news cycle before it ever hits your feed. Look at recent market data. Over the past few weeks, there have been at least 5 distinct moments where a single public statement or social media post from Donald Trump instantly triggered aggressive 5 to 12% price swings in Bitcoin. Looking at the numbers on this digital display, you can see the scale of what is happening here. Bitcoin is a $1 trillion asset. A 12% swing means hundreds of billions of dollars in market capitalization are created or erased in seconds, based entirely on a political soundbite. Regulators are currently scrambling to track down exactly who is profiting from this. The SEC is zeroing in on a series of highly suspicious leveraged trades executed perfectly just moments before those political posts went live. You are operating in a rigged casino. When you buy into a sudden price spike, you are often serving as exit liquidity for an insider who knew exactly when that spike was coming. Because traditional equities and standard exchanges are now so heavily manipulated by these sudden external shocks, institutional capital is migrating to a completely unregulated environment. They are pivoting to prediction markets. Instead of buying a stock and hoping a political event helps its price, investors are placing massive bets directly on the political outcomes, the court rulings, and the exact timing of the market manipulation itself. This chart maps out exactly where the smart money is heading. Analysts at Bernstein have modeled this growth, projecting that these decentralized derivative contracts will explode into a massive $1 trillion industry by 2030. Whenever billions of dollars pour into a highly volatile asset class, extreme greed follows. Retail investors chase promises of guaranteed yields, blindly putting their savings into protocols that eventually collapse as devastating Ponzi schemes. When retail investors lose capital to fraudulent yield protocols, they face total financial ruin. When an ultra-high net worth Wall Street whale gets caught in that exact same trap, they don't panic. They quietly open the tax code. A few years ago, the government suspended miscellaneous itemized deductions, eliminating the ability for everyday traders to write off standard investment expenses. But the elite retained a highly specific failsafe. Hidden inside IRS Publication 17 is a protected provision allowing individuals to claim losses from Ponzi-type investment schemes as a casualty and theft deduction. The U.S. tax code effectively operates as a 2-tiered system. A massive financial scam only permanently wipes out your wealth if you don't know the precise legal mechanism required to weaponize that loss. Say you secure a $2 million short-term capital gain. You owe $800,000 in federal taxes. But earlier, you invested $1.5 million into a crypto fund. The founders vanished and your money is gone. First, document the fraud by reporting the exact loss on IRS Form 4684, Section B. Next, carry that $1.5 million loss over to Form 4797. Finally, that loss drops directly onto your Schedule A form, line 16, as an other itemized deduction. You take that $1.5 million Ponzi loss and apply it directly against your $2 million in taxable gains. Instantly, your taxable income collapses down to just $500,000. By executing this maneuver, you legally erase over $600,000 in federal tax liability. The federal government ends up subsidizing nearly half of your massive financial mistake. We are operating in an environment where a single social media post dictates the direction of a $1 trillion asset class, while federal regulators constantly play catch-up with coordinated insider syndicates. You cannot build an algorithm fast enough to beat the frontrunners, and you cannot consistently guess what politicians are going to post online. The only element of a chaotic economy you can completely control is the structural defense of your personal wealth, specifically through the strategic utilization of the U.S. tax code. Understanding obscure provisions like Schedule A, line 16, dictates whether you are wiped out by a rigged system or whether you have the tools to survive it. To navigate the explosive growth of the $1 trillion shadow economy, you must stop operating as exit liquidity and start utilizing the defense mechanisms of the ultra-wealthy. Hit the subscribe button to track these insider strategies, and I will see you in the next breakdown.